Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
So, guys, we absolutely have to talk about what happened in the markets last week. I don't want to talk about like the indexes, like all the stock market stuff, but it was related to mortgage and real estate. But we really need to talk about rates because something happened last week as far as rates like plummeting really fast, and then they came back really quickly again this week. So I want to talk about kind of what happened and then what should people do about it. And it's all about rates today. All about rates and all about mortgage preparation. Sound good?
What happened?
What happened?
Jesus, what happened?
Like a mini rug pull.
It is just crazy. It's just so much uncertainty out there, Andy, and it's just crazy to see everybody's just like scrambling, trying to figure out what do we do. As a matter of fact, I had my appointment with my financial advisor. Luckily, he's cool, Mr. Scott Dudley. He took me out to lunch. It was great. And I got to see how hard my stocks got hit.
It's like, hey, hold on tight.
But like he always says, it's all about time in the market. So it's luckily I'm not ready to retire next year, maybe in 2, and hopefully we can replenish
2 years,
that.
right, Brian?
Yes.
We're going to be ready in 2 years, Brian.
But
all right.
we'll figure this out. But yes, absolutely. All this volatility that's going on. So I think these are great articles, Andy.
Yeah, I only picked 2 because they're really just about mortgages, and they're kind of both of they're really the same. There's two different angles. We've got Housing Wire, one's from Housing Wire, one from CNBC. So I want to talk just real briefly about some of the things they were covering, kind of as like a premise of the longer conversation today, which is what should people do and why. So can we just start with the things? Okay, so by now you probably would have already seen, heard, or been told that the stock markets were basically like routed at the end of last week, and it was in reaction to a lot of the tariffs, but everything went down. It was like an everything sell-off. I mean, even the 10-year yield was going down. So, typically when the indexes are going down, the bonds are going up, or vice versa. There's because money's looking for safe havens to go. People are looking to put money in a place where it's going to be safe from being completely eroded, or at least slow the erosion if it's in an eroding kind of environment. But what happened with that is that mortgage rates got drawn down super quickly as well, but it was only for a brief moment. Yeah. So when you saw the stock market rout happen, at the same time, bonds were plummeting, and also mortgage rates were kind of following them in this descent. It's kind of like on the roller coaster. There's like the front car and there's like the back car. So the back car ends up going where that front car goes, and so that's kind of a little bit what happened last week.
Gotcha.
And so really the simplicity of the story is wherever we see the 10-year yield go is the good indicator of where mortgage rates are going to go, whether it's the same day, next day, same week, or whatever. So that being the case, last week we saw mortgage rates plummet because of uncertainty and massive volatility that we haven't seen in the markets in really 5 years, since 2020, when it was like shut down, COVID, March 2020, and then boom, like everything sold off. Like that was kind of how it felt initially. And what'd you guys see on the mortgage rate side? What happened right away?
So we experienced a short-lived, just plummet in the rates, and obviously, phones started ringing. We started getting more inquiries about hey, rates are on the low. Where are we at? Can we refinance? Is now the time? But that was followed up by a very, very, very dark Monday where everything basically just got taken back and some. And now what I wanted to drive home is that this is more like of a a recurring theme that we've been speaking about. And what I want people to understand from this is that times like these are going to happen throughout the year, and they have been happening in the last couple of months. But in order to be able to be ready for those situations when rates just take a wild drop, you have to be prepared and you have to be ready. And I think the biggest thing I could say about this is that you have to be ready. And by being ready means that you have to, run the course and, give yourself a financial runway to be able to, take those opportunities when we have lower rates, as we did last week. But if you strike when, rates are, when they're saying that rates are down, you're probably too late.
Yeah, no doubt. The good thing about this is we have seen interest rates at its lowest in 2025. Yeah. This is the best. And still today, it's the lowest rates we've seen. In comparison to how they're comparing it to is we saw these rates back in October of last year. Mm-hmm. So it feels good that we're actually seeing some type of rate reduction, but again, these tariffs are having a huge impactful influence on our interest rates. We saw unemployment was worse than expected. And still, normally when we see that, we see the bond market react to that in a positive way where rates are in our favor. In this case, it didn't. It was actually the reverse. So it's pretty confusing to really tell what's really going to happen. It's just time will tell.
Yeah, and I think broadly, kind of at the macro level, like the big high 30,000 foot level, it's that the proposed negative impact of tariffs, it's just crossing so many sectors of the economy and so many sectors of industry that it's creating broad uncertainty. I know you guys keep using that term because it's the right term. The bias, I think, long term for mortgages is going to be lower because there's no case to be made for them to be higher. Part A. Part B, if the administration's intention is to stimulate the economy to grow, increase GDP, kind of, let's say, stabilize unemployment, not completely you can't eradicate unemployment, but stabilize unemployment and have price controls in place, you're going to look at a couple of other issues too, which is going to be like fuel, for example, like oil is going down. And then that ends up making its way through commercial spaces. And then it makes its way into people's pockets on the residential side or on the civilian side too, where, you're just paying less at the pump. But less than the pump makes its way into the into food and to all the things that are delivered. So long range, the bias, I think, is mortgage rates going to go lower. And you saw like a really quick like knee-jerk reaction the other day where it just plummeted right away. Yeah. But man, if you weren't there to catch it, you missed it. That's to Brian's point. Now, on the other side is this is like the lesson. Okay, well, if that's a merry-go-round and that's gonna come, if that horse is gonna come around again, are you gonna be ready to get on that horse when that thing comes around? Because it ain't today when we're recording this, but if that happens next week or next month, are you gonna be ready to jump on it?
And for first-time homebuyers or people that are looking to buy another house in 2025, getting pre-approved is probably going to be one of the biggest things you want to do beforehand, 3, 4, even 6 months out, to give you an idea of what you're working with as far as your actual numbers, your amount of payments, and knowing that clarity is going to set you up for those days that come and you have a low rate and you could get in there, submit an offer, rather than doing it the other way where rates are down, and then you go get pre-approved, and by the time you get your approval, you submit your offer, rates are already back up. So right now is the time to start getting ready, prepare, because in these next couple of months, like we said, rates are going to be coming down as we see the 10-year already dropping. So I think it's giving you a very, very clear idea of what we can expect.
Now, a lot of people are going to say, but you saw that 10-year, it came right back up to where it was on Thursday or Friday last week. It's like, yeah, that's fine, but it's exhausted all its fuel. So think of like a rocket, plummeted towards Earth, and then it had refueled, and it came back up, but it came to its starting place. Yeah. It has not rocketed through its position prior to that. So the overall trend still over the 30, 60, 90 days is still downward pressure ahead until it's not. And that's not me just like scapegoating or trying to play it safe. It's just that is the forecast. Yeah. And so if you're looking to buy a house and you want to buy that and you want to be in that house with keys in hand in 60 or 90 days, you have to start now. Yeah. It's going to take you a couple weeks to find a house. Then you're going to have a 30-day escrow or shorter in some cases. Well, then you might find an optimal time in that window where you got to lock and close, where you can actually lock and close at a decent rate.
So I had a client that reached out to me on Thursday, sent his documents in on Friday as he knew that rates were coming down. And Monday came around, rates were completely different. But, we were able to explain to him that, hey, this is only temporary. If we lock today, we're losing a lot of, of the battle. But if we strategically get ready, get all your information in, get your application dialed in, send it into the bank, and then wait for the rates to drop because they're going to be coming down and there's going to be those pockets, then you're going to be in a better position to then score a lower rate, get a better deal rather than doing it, beforehand. And that's what we're doing right now, basically getting everything submitted and then just parking, because his goal is to close next month to be able to miss those 2 payments strategically by doing that refinance. Yeah.
And I want to connect this point really quick to what Brian's saying to something that was referenced in the first one, which is the Housing Wire article where this guy was quoted saying, the shift has driven bond yields lower, which in turn is pulling mortgage rates down. The rapid rate movement underscores just how sensitive the market is to policy headlines and geopolitical developments. Mm-hmm. And this is why we advocate people be ready ahead of time. This is our entire thought summarized in one sentence, is like your point about, hey, if you're showing up today with your documents, but you can't even lock today, it's too late. So you got to get a day ahead of that. Go upstream 1 step or 2 steps. And I know we kind of beat this drum constantly and we beat this horse dead, but it really is true, because for anyone who's watching this and did not take action on Thursday or Friday of last week, because either you didn't know, also beware that this is how closely this market that we work in follows the things that are happening at the headline level geopolitically.
Oh, it's very, very, very volatile. Everything that's happening is very volatile. And it seems, Andy, that we have amnesia of other presidents that have actually done this. I actually took the liberty here, and I know that these are tariffs. This is not a new thing that's been implemented. As a matter of fact, on the first, when Trump took office the first time, tariffs were in place, and just remember, everything worked out. Okay. So then if we look at 2009, it says here, President Obama imposed tariffs on Chinese tire imports to protect the U.S. from manufacturers. Then we look at this and we go in 2002, President George Bush implemented tariffs regarding ranging from 8 to 30% on various steel products to safeguard domestic steel industry. It doesn't stop there. Then we go 1987, President Ronald Reagan, what a president. I was a kid back then, but imposed 100 tariffs on 300 million worth of Japanese imports. So these are not new things. These are things that happen. These are, I feel like, necessities. And I just feel like, yeah, is it going to work out? We just don't know. This is uncharted grounds right now, the way he's taking things. But if it does work to our advantage and interest rates drop, as they're saying he's trying to create this recession, there's a purpose behind that.
Yeah.
And so what we got to understand as, citizens of this great country, we got to acknowledge that certain things have to change in order for us to start being able to refinance that deficit. So with this interest rate drop, that $37 trillion deficit automatically becomes in our favor. We can reduce that debt just by refinancing to a lower interest rate. So there's just more that needs to be added to this and more clarity. I bring this up because just like they did the uncharted territory when they increased the tariffs, they didn't know, these presidents didn't know what was going to happen, but things ended up working out, And so right now, our housing market, we've been in a 4-year recession since 2022, and interest rates increase. We know home sales have been at its worst ever.
Yeah.
Yep. And so here we are seeing an uptick. Today, I researched, and we have 691,000 homes available. And we talked this a couple years ago when we were in that 300 range. What's it going to be in June? And we're all saying like, oh, we think it's going to be like 500,000. Well, it took longer than we anticipated for that.
Yeah.
You know? So we're starting to see more homes coming out on the market because I think people are now being more susceptible to understanding this is the new norm.
Yeah.
Interest rates, this is going to be the new norm. And so now I'm going to go back to, I got to get in where I got to get in, where I'm going to live my life now more comfortable, and I'm just going to have to refinance at a later time because now we can see at least a little bit of that light at the end of the tunnel.
So you're touching on, I think, some of the core things that I want to talk about when we get to the second half of this conversation today, which is refinance boom, yes or no, inventory is coming back, and time in the market, as you mentioned. But is there a timing of the market? So I'm going to hit one of these, hit each of these nails kind of on the head real quick. So just knee-jerk reaction. Do you think we'll see a little mini refinance boom in the next 90 days? Agree or disagree?
Yes, agree.
I agree.
Agree. Okay. And then, so when you start talking about inventory, you're mentioning there's more homes for sale now. In March, there was 10% annualized jump in new listings from March of 2024, and active listings up 28%. So this is obviously good for inventory. Now, with this increase and this surge of inventory, at the same time that you potentially have rates softening, it's going to solidify that prices where they're at are probably where prices are going to stay. Now, we've talked about this before where it's like, 35 or 36% of listings have price cuts. Like, well, that's normal. Like 30 to 35% is actually normal until you see something like 40 or 50% of listings having price cuts. We're not in a pricing issue. I think that right now with the increase in inventory at the same time that rates go down, I think it's actually going to put prices in concrete.
Yeah, no, absolutely. I just love how the headlines right away. The rates are going down. You know what? But the rate sheet doesn't say that.
The rate?
Yeah, the rate go in there. Yeah, the rates have gone down, but it's at a cost to the consumer.
Right.
So it's like, I love how they put all this information, and then, we have refi boom could be near. The good news is rates are going down. But again, the rate sheet does not imply that. Yes, you can go at a lower rate. It's going to be at a much higher cost now because of that.
Another good example, another tip that I'd give right now is if we know that when you see the headlines, they're maybe a week old, it's even more to your benefit to consult with a real estate professional locally in your area or wherever that may be, someone you trust. Reason being is because we're seeing this information in real time. We follow the market in real time. Andy, I'm getting messages from you at 5 a.m. Will's replying back at 6. And what I want to say about that is that, we see this day in, day out. So somebody that follows the news, they might be getting their information maybe a week old. It's probably already been sold. the market already, processed that information and they're onto something new.
Even 24 hours.
Even 24 hours is a long time. So therefore, having that real estate resource at your disposability, being able to text them, like that's giving you the door to the information that's right there, live and ready for you to make the right decision, rather than waiting and then you're just playing catch up all the time.
Absolutely. Yeah. So I couldn't agree more, Brian. So especially if you're an aspiring home buyer and you have your realtor in your corner, like just be tight with them, like be lock arm in arm right now, digitally lock arm in arm via text or email or phone call, whatever, like lock arms with them. Same thing if you're a homeowner and you're trying to save money by a refinance or HELOC or something like that, lock arms with the loan officer. Call the loan officer you used before. You don't have a loan officer? We got two right here. Reach out to these guys and get close, stay close. And then we're also sending updates. Every week you're going to hear from us, and every week we're looking at what's going on in the macro level, but every day we see what's going on the micro level. So you're always going to get like the most current information by reaching out to us, texting, calling, etc. So the question I have for you guys then is, given this state of kind of variables that have changed and kind of like everyone got this like wake up the other day, like, whoa, look at the markets go. Do you think there's a case to be made that the spring could be the right time to get in the market? I know we talk about time, long-term time in the market, but we try to tell people avoid timing the market. It's not going to be perfect. Like, do you think that given these set of things coming together, there could be a case to be made for timing the market and buying in April, May, or June?
That's a great question. And the whole timing thing in real estate, it's always been unpredictable, right? Because things change so fast, things are so volatile that, as you can see, when the most influential man, Uncle Powell, just says a certain thing, things just go sideways. Mm-hmm. Okay? So I just say just get in if you can. It doesn't matter what type of market it is you just got to get in and just wait it out. That's just going to be longevity is going to really take, have that advantage where you can actually reap the rewards after a certain amount of time. But yes, spring's going to be good. There's more homes available. Therefore, that brings more opportunity to a first-time home buyer, a second home buyer, where they can negotiate closing costs. We're seeing a lot of that stuff. When there's more inventory, there's more selection out there, so there's more options. Now you can truly use the art of negotiation to your advantage.
Yeah.
I say yes, but it depends on a few factors. And I'm currently working with the VA buyer, and his timeline is 3 to 9 months, so he believes. He got out of the military service last year. He's joining the police force right now with CVPD, and his goal is to basically acquire a property for him, his son, and his wife. But he's like, I don't know, with the payments being so expensive, I'm not getting full police pay yet, so I'm still basically kind of working my way. What I advise them is that the more that you put yourself in opportunities and you go out in the market and see what it looks like, run the numbers, and consistently see what opportunities are out there, you're going to start getting conditioned to seeing what it is that you're willing to sacrifice, what it is you're not willing to sacrifice, and you're going to start testing the waters to see if you're ready, or if those 3-6 months is really where you're at. Because now you say, payments are going to be this much. I have to then budget for at least 3 months of payment up front. So all these things that you're doing while preparing to buy your house are very crucial, because you're also learning through that process how to submit offers, how to negotiate, how to take it when your offer doesn't get accepted and you thought it was going to be the one. So all these things are building what I call credibility, and you're also getting experience of how to purchase a house. So I think getting in as soon as possible doesn't mean that you're going to buy a house the moment you get pre-approved. It's going to start the process for you to understand what that looks like, and then you can make a better decision down the line whether your timeline is correct or you're ready to move as soon as the deal comes your way.
Yeah, no, that's really good, man. And kind of summarizing this entire setup today is for me is one of the final things I had read in preparation for this week was this quote: recent improvements in mortgage rates bode well for the late spring and early summer housing season, as long as economic concerns settle and don't knock buyers off course. And, Brian, to your point of like, hey, sometimes you just got to make reps. And yes, does everyone submit an offer thinking, I hope my offer gets accepted? Yes, they do. Otherwise, they wouldn't have made it, right? But sometimes your first one doesn't go, or your second or your third. It's just like kind of the reality of the situation. Like, I'll be honest. I didn't have my best day at the gym the first day. My second day was only my second best day, and my third day was only my third best day, right?
That's a great point.
Unfortunately,
that's a good point.
Because you don't have offers getting accepted right out the gate every time, you're going to get a couple of reps, but use those reps to kind of bolster yourself a little bit. Have a little extra thicker skin going into the next one, and then really kind of refine that process with your realtor and your loan officer. So,
and the great thing now is we're predicting in 2026 we should be to that norm of how many homes we have available on the market.
Yeah.
Because I'm telling you, during the pandemic, it was just crazy how people just jumped in. That's why we saw within 2020 and 2022, we saw a 40% increase in home equity, just because of the limited supply of homes that we had during that time. And so hopefully now we're going to get back to that normalcy.
And I think that there's an element of this that has nothing to do with what we're talking about, but I'm just remembering it right now. I think I saw the stat that 10,000 people per day are turning 80. 10,000 people per day are turning 80. And a lot of those people are going to end up having to sell, move out, or, they're not going to be able to upkeep and maintain their home. So I think there's going to be a subset of inventory that's just kind of a byproduct of aging in life. And that's going to continue for quite a while because you got that boomer generation coming through, guys. So
absolutely.
I want to kind of pivot, and now we've kind of established kind of what's going on, why is it going on. I wanted to talk about top 5 mortgage moves people can make in April, May, or June of 2025. So I know that I prepped your notes saying it's April, but really, honestly, I think it's for this kind of quarter.
Absolutely.
It could go as far as July or August because we still have like the summer buying season. Maybe it's a normal summer buying season. I don't know. I think it's at least going to be.
Hasn't been.
It hasn't been.
Hasn't been.
I think we're at least in for 3 months of like real, I'll say positively aggressive real estate moves because people are going to be able to get this inventory that's on the market. There can be days where the rates are really super low. And now that people can actually justify a refinancing, they will. And then the people that are in financial pressure that have to are going to do that too. So I think, honestly, we're in a sweet spot. So let's talk about these 5 things really quickly in order, and I want you guys to chime in on all these. So number 1 of top 5 things to do in April, May, or June of 2025 is run a refi check. Even if you refied recently, just do a check and see what's going on with rates today versus what the rate is you got prior. Yeah. Go ahead. What do you guys think of that?
No, that's great. That's very understandable. I mean, we acquired, what is our current consumer debt? Was 1.2, 1.3
credit card debt? Yeah, it's like 1.3 trillion.
1.3 trillion. So that's the highest debt ever, we've ever had. So that's telling us, and we have the most equity a homeowner has ever had. So obviously consolidating, it's not in its favor for people that have maybe a $20,000, $30,000 debt, but the people that we've been assisting, we're talking about they have $100,000 to $250,000 worth of debt.
That's crazy, dude.
So if you consolidate all that, it makes the math still maths. So
the math still maths.
Exactly. So it still works out. So it's always good just to consult with your financial advisor. Because a lot of times we stop putting it into our retirement because we're like, well, wait a minute, I can't anymore. I need to pay off this debt, and so those certain things happen. So you want to be just, how do I continue to progress on my retirement, and how do I get out of this debt? A lot of times the best way to do it is go to your home.
Yeah. Brian, how about you?
Yeah.
Run a refinance check.
So especially talking to the business owners and self-employed that bought maybe 2 years ago have a 8% rate or 7.5% rate. I think right now is the perfect sweet spot to start seeing where your refinance is at so that you could better prepare for those months that come down the line where we know rates are going to start dipping lower. But what you're going to do is you're going to be able to compare where it is at right now. You don't necessarily have to pull the trigger, but it is a starting point for you to know, what the numbers look like. Then compare it with it 3 months down the line again so that you can always know what your savings are at. Down the line, you're going to have that opportunity because you're going to be ready. Your documents are going to be submitted, and at that moment when rates come, maybe the savings is going to be good enough for you, and you can make that jump. Right now, we're working with the client that bought 2 years ago at a 7.5 with the bank statement loan. They were self-employed borrowers, and now they filed their taxes, they got their income in line, and they're going to be doing a regular conventional loan, looking to land at least 1% lower than where they were at originally. So if you're a self-employed or own a business, you bought a house within the last couple of years, check your refinance and see what the numbers are looking like.
Yeah, if you're in the 7s or 8s and you're looking down at those 6s, take a good hard look at those 6s. So do that refinance check. The next thing, guys, number 2 here is like lock in your rate. Now, my position on this, I'm gonna let you guys say your own piece from the loan officer perspective. Is like we talk about this constantly. Like, get yourself ready, have all your document ready and prepared, and then when you can actually have you've gone down the road far enough where you can secure and lock in a rate. Like, be ready to strike when the iron's hot. It's a given for me. So take it away. Lock in your rate.
Yeah. What's the saying? Lock it, dock it, put the money in your pocket.
Lock, drop, and cover.
Yeah.
I told you guys this story. Sorry, I'm going to take it back just for a second. I think I told you guys this story, and I'll spare sharing his name. But many years ago, when I was still originating loans, I had a client who was really just on the fence, didn't know what should I lock today, should I float and see what tomorrow. And I finally did. I said both sides of suggestion to him, and finally, what it really just came down to was, which way do you want to wake up and be mad tomorrow? Do you want to wake up and be mad tomorrow that you lock today and rates are lower tomorrow, or do you want to wake up floating today and then tomorrow they're higher? And he's like, oh. Okay, lock it now.
That's a good perspective.
And it was because, look, one's going to happen. And the chances of being neutral today to tomorrow in a volatile market like now is very low. It's either going to be higher than it is today or lower than. Which way you want to be mad? You want to float and be mad that it's higher, or you want to lock and be mad that it's lower?
Listen,
and that helped out.
That's awesome. Just to put in perspective, when we went on Thursday, right before everything changed in the morning, when we priced it for the client, I was going to give them at that 6.25 a $4,700 credit. By the end of the day, the market just shifted. I was only giving them a $700 credit.
Whoa!
That's how fast the market deteriorates. So when people tell me, "But wait a minute, if you lock it, can I lock it any time?" No, we really have to time it right. If people don't understand, these rates change on a regular basis. Right now, you're seeing a change today was just 18 times already.
Yeah. And for people who don't know what he's talking about, it's called intraday rate change, where literally the rate sheets that we have in the morning, as the market's shifting, and if it's going super wild, that's going to change for the better or the worse while we're still at work working.
Correct.
While the markets are still open. They're making adjustments on the banking side for what their prices they're offering the money to us to offer to you. So that can change in a moment's notice, and you just get an email, intraday rate change, and you go, whoa, wait, hold
right
on.
Now, the way we try to strategically plan for the client, since we already know that interest rates will drop, is don't buy your origination points. It usually takes around 6 to 8 years to recover that origination point. And if we're going to refinance in 9, 12 months, there's no reason. Keep the money in your pocket. Have a higher interest rate. So when people are telling me but Will, I like my payment to be at $5,500, and it's at 58. Well, I tell them, put $300 aside. Instead of buying a point, put $300 aside, multiply that by 12, and then put that on the side. And you still have that payment. I know it's higher, but at least $8,000, $10,000 doesn't just go towards buying a point and you're going to refinance and just throw your money away.
Yeah, that's a great a great point.
So there's these instructions that right now, it's so important to educate our client, to help them understand where their money's going to go and why we're planning on this roadmap for them. So when they see origination, 8,000, 10,000, you're just buying down the interest rate, an interest rate that, in 8, 9 months could possibly go down. And it's not like you're going to be locked in for 30 years on that.
Yeah.
And so
not gonna be
especially with all the data, everything we're talking about right now is based on data. We're not just making things out. We're following the candlesticks. We're seeing where, paying attention to inflation, CPI, and all that good stuff. I won't go through all the,
all the acronyms
here, but we're paying attention to these things. And so, the way we do things, because I have 19 years experience in this industry, I'm not just an order taker. I'm here to be a resource to the client, be able to guide them into what I would feel I'm going to do for myself and my family, right? So buying right now, origination, all that, I'm like, that's just throwing money away. Unless the seller gives you a substantial amount of credit, then we can apply that towards buying down the rate, doing a 1-year buy down, a 2-1 buy down, depending how large that credit is.
It's really important that everyone understands that you guys are advisors, not assistants. Yeah. That's the deal. Your people are coming by. You keep saying 19. Did you know this is going to be your 20th year?
It's going to be, yeah. That's why I say 19.
I know, it's so crazy.
I'm going to round off 20.
I know. It's just...
It's crazy, I know.
Yeah, when we started this, I actually used to comb my hair. Yeah. Congratulations on your full head of hair still, 20 years later.
But I'm glad that you bring that point, because it's so important to understand when to lock and go. You mentioned yesterday that you had a client that was refinancing, found you online, looked at your reviews and said, hey, you stand out to me. And so he reached out and he said, I was ready to refinance in October.
Yeah. So importance of locking your rate. So, and who you work with honestly really does matter. He came to me, told me, hey, I got the appraisal for my house. I was ready to submit my my information. Everything got, sent to underwriting, and I was ready to send my conditions. Loan was approved and everything. We're set to close. And I'm like, hey, where's my closing disclosure? Where's my fees? And he's like, I didn't hear from the loan officer. Crickets, 1 day, 2 days, the third day, it's a Friday. Hey, I was sick. This and happened. The buyer didn't buy that. So it came to be that he didn't lock the rate. He's like, honestly, I'm sorry, but I didn't lock the rate. And where he was going to save in the low, like he was going to go to like a 5.875 because rates dropped pretty significantly. It completely tanked and he was back in the sevens. And it all came down to because not locking the rate strategically. The loan officer that was working with them, unfortunately dropped the ball and wasn't able to lock that in. But, things happen, and that's why it's so important for you to, constantly be on the alert for, those documentations that if they ask for something, send it right back. If they're not responding to you within a matter of time, check in. Feel free to call them because, they're going to have to respond.
And I'm going to also give the reverse side of that. Yeah. Back in August when rates were actually, I remember the VAs were actually been looking at the 4.99s, low 5.25 and no cost. But obviously the consumer get fooled a lot by all the solicitors that send them mail.
Yeah.
And so, I'm going to give you a 4.99. And then next thing they know, there's cost behind it, and therefore they don't go that route. And so various clients, we already pretty much had them ready, 5.25. And no, we think the rate's going to go down. Not understanding that 4.99 to 5.25 was only like $120 difference. Well, fast forward, they haven't refinanced.
Yeah, now we're in the
so
sixes.
Now it's cost them. It's still costing them more, and so it's like there's also that side of the coin is the consumer also has a control to say yay, nay. And when they say nay, they think they're going to listen to what the media has to say. And here they are. Now we got August, September, October, November, December, January. They could have saved $500. Look how much more they're paying now.
And they could stairs again and then refinance again.
So how much more are they paying? And now it's like, and I hate to say it, but I told you so.
Yeah.
We were ready. We were ready. Ready, prepared. We just had to put that lock in and have their commitment. But sometimes there's a flip side of the coin.
And I'm glad you said that because to your credit, you are admitting you have both sides of this conversation where some people they should know better, they don't, and then there's a consequence to that. Yeah. And then there's the positive consequence of, hey, I tried to and I didn't, but now I need to, and it's going to work out. So just as not just for the variety, for the sake of variety's sake, but like there are two ways this can go, everybody. Yeah. This can go really, really for you or really, really against you. So this second one of, locking your rate is a critical one. But again, back to my arm in arm point, like you got to be arm in arm with the loan officer, be close, stay close to the market. And if you are not yourself close to the market, then they are, and they're your best bet. So if you are not in the center of the epicenter of what's going on, like the center of the epicenter, if you're not in the epicenter of what's going on, you got to get right next to the guys that are. So that's my final point on that one.
And also, whoever you're working with, keep them honest, just like anything, there's doctors that graduated with D's, C's, A's, and B's. So, make sure you do your due diligence as well. And you ask, more in-depth questions, and they're not just saying yes to everything that you're asking for, because you also want them to be the professional that, lets you know what you need and not what you want. So, take that with a grain of salt and play it.
So this third thing here, guys, is to recast your mortgage instead of refinancing. Essentially, if you've made big lump sum payments or have extra cash, a mortgage recast might lower your monthly payment without changing your interest rate or term. You have to have a lender that's willing to do that, first of all. But my point in this is you can also use the mortgage accelerator like we've talked about too, where you can be making extra payments every month, quarter, or year. And by doing so, you'll self-accelerate your payoff date, which in effect reduces your total APR paid over the course of time. Yeah. What do you guys think of this idea?
No, this is great. I mean, I think it's a great thing for people to understand. Like there is a bi-weekly program that you can do in there. It just equates to a 26 payments, right? Because you're paying it every other Friday. And therefore, that right there in itself, on average, it saves you about 3.5 to 4 years out of the life of the loan. Yeah. That could equate to depending on the loan size, anywhere from 50 to 180,000.
Yeah, tens of thousands of dollars.
Yeah, just by doing that, you know what I mean? And so the other thing, like something I've done, and I've done it for many years, is since I bought my house, my payment was $2,600, and I just put $400. Mm-hmm. I was already paying more than that, so I just figured put $400. some people say you shouldn't be paying off your home. Yeah, I agree. I shouldn't. But there's going to be a point in time where I'm going to have to probably go into it in case of emergency, break glass open, and now I could tap into my equity that much more, And so a lot of times you have it in the mindset that you want to pay your property off because that's the right thing to do. But if you have this ton of equity in there and you can invest that into other investment vehicles that can give you a greater rate of return than my current interest rate that I have at 3.625, I should have refinanced, but I never did. It's kind of like the contractor you see holes in your house and you don't fix them. You know what I mean? It's like, whoa, what? I didn't take advantage of those shoes. Anyhow, I think it's a great idea. But what I'm understanding here on the recast loan is kind of like a vehicle, and I've done this in the past, Andy, where I came up with a good chunk of payment, and it was a purchase, and I applied $10,000 into it, $5,000. Then I asked him, like, hey, can you extend me back to the 5 years? I know already 2 years in, but now I got I just want a lower payment. Yeah. Can you do that? Because my goal is still to pay it off. I'm going to pay extra to pay, but just in case of emergency,
I'd rather keep the low payment.
Exactly. So that's what I hear that this is stating. I've never seen that happen. That's my thing.
Yeah.
You know what I mean?
You have to have a bank that's willing to do that.
That's more of a case by case.
That's why I mentioned like the recast is more on your own. It's not that you're getting them to do it for you or like literally rewrite your note, but that you're going to self-accelerate the things. That was more of the point.
So on the self-accelerating one, just, close it out. I feel it's one of those things that everybody can, but not everybody could, or not everybody will. Yeah, so I think it takes a very smart, I'll take that back, a very organized individual with their finances to be able to play this out and strategically do it so that, you do get the benefits. Some people probably do it 1 year, then they don't want to do it anymore. So somebody that has all their finances in a spreadsheet, or just someone that is very smart with their finances, I think this is a very good play for them because they see that they're paying off, their debt faster. That makes them happy. And at the same time, they know where all their money is going.
Discipline. You're talking about discipline, having financial discipline, fiscal discipline. That's really good.
Yeah, having a budget, right? Budgets matter.
Yeah. So the fourth thing here, guys, is tapping into home equity while it's still cheap. This is a relative conversation. Whether you look at the HELOC rates on their own, standalone, you look at them historically, looking back and how high they were before and where the pricing is now, or you look at the blended rates. You have a 2.5% on your first, like, I don't want to touch that. Oh, but a HELOC is 12 or 14. Well, okay. Well, if the HELOC is 20% of your total outstanding loan and the 2.5 is 80%, well, then your blended rate's looking pretty good. It's going to be pretty low. So what do you guys still think about HELOCs now, spring of 2025?
I think it's good. I think it's a good option to have. I have a client, she purchased with their VA. She had a low twos. And even though we do HELOC loans, I always say go to the people who you bank with.
Yeah.
In this case, she banked with Navy Fed. She went over there. They gave her a line of credit. And I want to say the interest rate was like 8.75, where ours is going to be like 10, 11%.
Oh, wow.
So that's a cool thing that it worked out right there. So usually like the smaller banks, like community household banks, they have much favorable terms. And I think it's a good option to explore.
Same thing. Credit unions also typically have pretty good HELOC programs if you're already banking with them.
With your banking,
Navy Federal Credit Union.
Yeah, it's their own money, right? So they're not going to sell that off in the secondary market or any of that stuff. They kind of hold it right there.
Yeah, it's either their own money or syndicated money among credit unions.
Exactly, exactly. So I think it's a good option always.
Okay.
The best thing to do is if you're consolidating, your average interest rate with your credit card debt and all that other stuff you're paying is in the high 15s, teens, and you can get it at 8. Well, why not?
Yeah.
And remember, it's not all a tax write-up unless you're investing in your home, etc.
Right.
But
Yeah, good point. But yeah, it's partly it's relative, partly it's constructive, and then also like be very what's the word I'm trying to think of, like thorough in your self-analysis of how's this going to help me rather than just kind of set me back. So
exactly.
If there's more ticks on the side of the page that are going to help you versus hurt you, then I think you still consider it.
And I have a client that took $130,000 to build their ADU, their 2-car garage into it. It cost them like $85,000 or $95,000. So the payment on that 130, I want to say, was like $900 and change.
Oh wow.
So you can rent that ADU once it's completed. You're going to rent it for like $2,000. So that's a good arbitrage.
Mm-hmm.
You know what I mean?
Yeah.
And because they're investing that HELOC into their property, the interest they're paying on that will be a tax write-off for them.
Yeah.
You know what comes to mind as you're saying that? How many people, once things pass over, go back and say, I wish I would have tapped into my equity. Like, I wish I would have done that. And if that's you listening right now, like, take the opportunity. If you haven't been listening, it's okay to run the numbers and not pull the trigger, but it's going to give you the idea. It's going to give you the actual numbers and facts of what can be done. And then from there, you could choose to make a decision or not. But, don't leave the opportunity hanging if it's been lingering in your head.
This pairs really well with the first one, which is running the refinance check.
Yeah,
so
that's
if you're running the refinance check, maybe the HELOC is a qualified option B, or maybe it is just your only option. But yeah, take a look and check it out.
Yeah, I mean, you bring a great point, Brian. There's a time that I wanted to do the same, and obviously it's based on income qualifications, and so. When I look back and I try to get that line of credit, I took such huge deductions as being self-employed that it didn't allow me to qualify. So therefore, I was not in a position to qualify for that. And if I had to do the hard money route, well, then it was just more expensive than I could actually afford at that time. So that you bring a valid point.
That's really good.
That's a great point.
Keep in mind as well.
Well, the last thing here today, guys, is to number 5, get pre-approved, be ready to pounce if you're house hunting. I kind of feel like we talked about this one. So, I mean, unless you have any other final thoughts, we already belabored this point. Like, hey, get yourself ready, get your house, get your financial house in order. You're going to be looking for a house for a couple weeks. Once you find a house and get your offer accepted, then you're going to be in escrow for a couple weeks, and then your first payment will be a couple weeks after that. So, any more advocacy for why people should be ready? Mine's
use the data that's out there. Build on the experience so that you have the certainty when you're out shopping in the market, and you're not just leaving it till let's hope that deal comes. You have a good understanding. You have your checklist of what needs to be done and what doesn't need to come into the play, and run with that. And don't let any distractions seep in, and just, lock in this season.
Absolutely. Knowing, building a budget with that by understanding your payments is very important.
Yeah. Well, I certainly I'm certainly optimistic. I will admit I've had my fair share of pessimistic moments, or maybe entire episodes on this show. I should say that before someone else says it in the comments. Don't you go write that in the comments now over there,
or write
off
it.
Camera, Caitlin. Or write it. Yeah,
or write it.
You're so pessimistic. No, but I've had my moments. I've had a lot of pessimism about certain things. But I think. Because there's been this shakeup, and it kind of it woke people up, wait a minute, what's happening? And it's kind of forced attention to go, here's what you saw, here's what happened, and then here's what it means. And I think we're finally getting to that here's what it means part, and then you can at least start having the conversation, whether people disagree or agree, you can at least start having the conversation on the broader picture, like you were saying, some of these things we have to do because we have other long-term big objectives, such as our debt, to tackle, and unless we face it head on, it will just continue to kick the can down the road, and then 36 trillion becomes 37, and 37 trillion becomes 38, and 39 and 40. It was only a few years ago that we were talking about 19 trillion, and at that time, 4 years ago, it was, that's absurd, that's so crazy, 19 trillion in debt, how do you ever do? Well, here we are now, almost twice that, in a very, very, very short amount of time.
80% of our current currency was printed in the last 4 years.
Yes.
Crazy.
See, now, I was all optimistic, okay?
Sorry.
And now here we go.
Sorry.
Hey, rates are going to be good.
Yeah. He's like, hey, let's open up that can of Andy rants. No, you're just fine.
But those are the things that we're going that are happening.
You're right.
I'm just glad things are happening. That's it.
Yeah. Again, whether this is good or bad, we're only going to be able to look in the rearview mirror and find out. But right now, I'm looking through that windshield going, I think I see some brighter days ahead.
Yeah. Just like anything else.
Let the medicine do its effect.
Well, what would you guys say is your favorite part of the show today?
I wouldn't say my favorite part, but the most important part is get prepared. If you're thinking of making a move in 2025, run the numbers. If I haven't said that enough this podcast, I'm saying it one last time. Get ready, stay ready, and strike when the opportunities come, and don't wait to get ready when the opportunities are there.
Okay, how about you?
Dang, you got it just right there. I think we finish up with that. But no, most definitely I have to agree with Brian is you got to prepare. You got to prepare. And just, put yourself out there for whatever odd reason. Whenever we get into this big debt, good debt, which is for me, a house is good debt, the world in the beginning seems very difficult. But after that, just like anything, like you mentioned, you go to the gym the first day, doesn't feel the best. Second day, you're kind of getting a little sore. Third day, you're very sore, right? And you're hurting. But then as you keep doing that, you know, and in this case, you keep making your payments, it's just going to feel, okay, I can get used to this. This is a new habit that I'm creating, you know? And so therefore, down the line, when you're able to refinance, you're going to be like, damn, I should have done this sooner. And it always happens like that. When you're doing something that is unfamiliar and then you go through the process, you're like, whoa, it was really that easy?
Yeah.
Dang it. Now I'm ready to take on that next stage of life and get into that next bigger home or whatever that may be. Because that's what we did. You know, I'm talking from the experience and based on the experience of my clients that I represent. It's crazy.
I love that. So my favorite part of the show today is the fact that this conversation has come up to the surface. You know, it's been, you know, dunked down underneath the water for a long time, whether it's, you know, mortgage rates or inventory issues. Like, we talk about it a lot, but on like the national stage, mortgages, mortgage relief, mortgage refinancing, inventory has kind of been like 7th, 8th, 9th, 13th, 18th on the list of things that gets talked about in the cycle. And I'm not saying that the news cycle validates its worthiness. It's just that I think we're at a point now where we're going to kind of turn a corner, hopefully, and see some of these things actually come back in our favor for people, not us three, but for the favor of aspiring home buyers and for homeowners. I think there's some relief ahead. And I want to kind of lastly say this because we've talked so much about preparation. And I actually want to ask you, Memo, to remind everyone who's watching, if this is your first time seeing this, the first time you've ever heard it, the house that you currently live in now, what year did you buy that house?
It was back in 2013.
And in 2013, in 2013, that was only a few years after the entire bottom fell out of mortgage and real estate. 2011, people finally started getting, let's say, confident, but like that was the early returners. I'll say the early returners to the market. That was the 2011 crowd, and you jumped in at 2013. And relative to today's value, how much was the house back then?
It's a 4,200 square foot home,
which at the time fit everyone in your big ass family.
Yeah, 5 kids and some
and the dogs.
Because you know how I am. I take everybody.
5 kids, the pets, and their friends.
The cleaning lady.
Yeah. I got that for $565.
Jesus Christ.
Yeah.
Gated community. And it was, you know, the seller actually paid for my closing costs because it was a short sale.
Yep.
You know, I got that, which was great. And fast forward now, 2025, we're sitting in like the, you know, high millions.
Yeah.
Which is crazy.
And the reason I brought this up is because I think that you back then did what we're telling people to do now.
Exactly.
Get yourself ready. And when that place comes up and you go, oh my God, it's $565. And you're like, oh, that's kind of hard. Ooh, the payment's 20. Well, now we look back at what, 12 years later?
Yeah.
And I don't feel like you regret that at all.
No. You know what, Andy? I don't regret even if I bought something at the peak of the market in 2008. Whoever bought in 2008, it still looks like a superhero. And that was a mortgage meltdown. That's when things were just skyrocketed. So even whoever bought that in my area, they were buying for 1.2 mil. Look, they're still coming up ahead.
Yeah.
So if you still look, you won't get that same home for that at all. Moving forward, it's not going to happen.
And the concluding thought for me in this, and the reason I brought this up, is there are seasons to real estate ownership where things are going to go really great. It's going to be, wow, beautiful, wonderful, everything's going my way. And there's going to be some rough clouds. It's raining down. Like, ooh, I just got to ride this out. It's windy. The walls are shaking, but, you know, at least I'm covered. I got a shelter over my head. And then the sunny day returns. And you look back and go, woo, yeah, we had that great time. And then it was kind of rough.
Yeah.
But, man, it's looking good again. And I think we're at that season now. So I wanted to highlight what you had done historically for some people that don't know that, you know, you made a choice that might have seemed crazy to outsiders looking in, that now you go, oh man, what a deal. You got that house for $565. That's crazy. It's 3 times as much now. That's nuts. By the way, congratulations.
No, thank you. And you know, Andy, full disclosure, I also lost properties during that time.
Well, yeah.
You already know. I was like, once I remember I mentioned.
But you didn't quit. The point, you lost properties, but then you're like, oh, 2013, I'm buying again. So like, you just dusted yourself off and you're back in the field.
I'm going to go back to that experience. When I first bought my house was 242. That was our very first home, you know? And then I remember Tanya and I talking about it like, how are we going to afford an $1,800 payment? Our interest rate was 8.75%. How are we going to do that?
Sounds about like right
It
now.
was crazy. You know what I mean? And we're just like, what the heck? And then next thing you know, we were in like 2 years into it. Like now we bought that other property.
Right.
$555,000.
Right.
Then we ended up buying a condo in front of Petco Park.
Yep.
And then we started buying another condo, you know, and then we bought the buildings where we're at.
Yep.
You know, and then we bought like 4 properties in Murrieta.
Yeah.
And they were all like 5,000 some hundred square feet.
So crazy.
You know, and it was just because in the beginning, when we first did that, it was like, whoa, what are we doing? And the next thing you know, that habit of making sure that you're earning that much income, you can pay these things, allowed us to get the confidence that we're just going to go for more.
Yeah.
And then next thing you know, the market shift and they took a lot of back. Well, no, luckily
the bottom fell
we
out.
remained this, and one of our other investments we were able to keep. But my primary, because I also got myself in one of those recast loans where my kids practically I raised them. I lost that property. I couldn't make that payment. It went from 36 to like 5,900. I couldn't do it.
Right.
That time was different, you know?
Yep.
So it's not always, you know, there's no losses here. There is losses.
Yeah, and that's what I wanted to end on. It's just that, you know, there's a real example that we have our own, but that's the one I wanted to highlight today, specifically because of what we're talking about in preparation. And you don't know that, but you can make your best educated choice with what you have, especially when you stay close to the sources or the people that are next to the sources, standing next to the campfire. You can have some warmth on your hands by their proximity. So
there it is.
Thank you guys for a great show, and thank you all for watching. Remember to like this video, subscribe to the channel. Also check out our playlist for Friends of Mortgage Heroes. Man, we've had some killers on the show already in the first quarter of this year. We have some guys that are like really doing it that maybe you didn't even know that are like really doing it, or they're like pioneers of our entire industry that also happen to be here in San Diego. So these aren't just, you know, your only local guy. They're local, but man, these guys are also national presence dudes. So go check out Friends of Mortgage Heroes. And then we're going to see everyone back again next week, right?
Next week.
Okay. Well, guys, thank you so much for a great show. Thank you all for watching, and we'll see you again next week. If you enjoyed this video and you want more of our content, subscribe here. And if you'd like to watch another video right now, click here.